Hey, good morning. This is Mayor Valensky with Driving Markets, driving while talking about markets. So a lot of the viewers are concerned that I'm driving, I'm going to have an accident, it's dangerous, I get fines. I've had some feedback on LinkedIn and on YouTube. So I've parked up and we're going to talk about markets. I don't want to make the viewer nervous. Remember, anything said in this piece is purely an opinion only. It's not financial advice and not investment advice. Furthermore, I have to be very, very clear that it's raw material. It's not edited. I'm not looking to cut and start and lighting and all the flashes. It's just simply raw material regarding financial markets, cryptos, foreign exchange, commodities, bond prices. Let's kick off. Yesterday, retail sales in the States, as everyone knows, came in much higher than expected. Now, normally that is considered great for an economy. Why? Because the more you have retail sales, the more profits is going to be on that particular company or across the board in the economy, adding more revenue to corporate earnings and more taxes for the actual government. However, in light of the present fear of inflation and rising inflation, it could be deemed and was deemed initially as a dangerous number, a number that's going to frighten the Fed into raising interest rates much faster. Why? Because consumer spending is now have total disregard for inflation. Spending is still there at a high level, and as a result of that, looks like interest rates is not having the impact that the Fed would normally have. So initially, equity markets sank. However, they reversed and ended up higher on the day. Now, what is going on in the equity markets? It looks like they simply are ignoring, discounting, disregarding any particular bad news. Now, high retail sales is normally not bad news. It's good news, showing it's a thriving economy. But in the present day, as I said earlier on, of an inflation era, it could be deemed as bad news, but equity markets ignored it and they wanted to move on. That would indicate that equity markets are not interested in anything that's going to remove them off track. They've got one eye on the target and they want to move higher. The Dow, the S&P, the Nasdaq, UK, Germany, Europe, Japan, they all want to move higher. Therefore, why they're moving higher? Probably because they view that inflation and interest rates have more or less peaked, even though inflation CPI on Tuesday came in higher than expected. Retail sales came in higher than expected. And obviously you've got producer price index coming out on Thursday. That really is already, as far as the market's concerned, even if it does come in higher, it looks like they want to move higher. And this is a very dangerous point. Why is it dangerous? Because the more they ignore the indicators that are leading to higher inflation, then when the penny does drop, what's going to happen? The markets are going to sink. And that's why I'm talking about a 25-30% drop in equity markets in 2023. The reason behind that is wage inflation, cost of living, energy prices, and obviously interest rates are going to go up. So housing, cost of housing, mortgages is going to go up. So I'm calling inflation in the US at really by June, July, probably about, realistically, without being stupid, between 8 and 9%. I have stated it could be 10%, but that is really far out, but could be 8 to 9% by June, by July in the US, with interest rates at 5.5%, 6% minimum. Okay, in order to combat that. Now, once you have those ingredients and you then have rising unemployment, you're going to have a market crash. I know a lot of people are saying that 2022 already was a market crash. That was nothing. That was a slight dip. I'm talking about a major market crash that's going to see equities, it's going to see asset prices drop through the floor. I can't continue the YouTube channel without talking about Bitcoin. Yesterday, massive jump, and also overnight up another $600. Looks like it's driving itself towards the 25,000 level. I have got it wrong, because at the beginning of the year I did say that Bitcoin's going to go to 25,000. It sort of struggled at 23.5, came down to 21.5, and I called it, you know what, looks like it's going to go to 19,000. But I got it wrong. Hands up, eat humble pie. Nothing I can do about it. It's very much a binary trade. It's an up or down trade. No fundamentals, no economics. Who the heck knows where Bitcoin is going and where cryptos are going, and therefore anything could happen as far as cryptocurrency trading is concerned. The dollar slightly stronger yesterday against the currencies overnight. Looks like it's gone a little bit weaker against the pound, the euro, and the Japanese yen. Interestingly enough, the 10-year Treasury is up to 381, indicating an interest rate rise at the next FOMC meeting. Remember, I said to you, the 10-year Treasury is very important. The bond market is an important measure of where equity markets are going, and the bond market is the true market, and it looks like bond yields are going up in anticipation of rising interest rates. Something to keep an eye on. I am calling the 10-year Treasury at 4.5%. going forward. Also, will there be sorry about that, there was a break. Okay, I'm going to call it a day now because I've got to take a phone call. This is Mayor Valensky with Driving Markets. Have a good day.